JEPI has been burning hot the last couple years. People are flooding their money into this ETF like crazy. At the end of 2020, it had $168 million under management, and that number jumped to 5.8 and 17.5 billion dollars by the end of 21 and 22 respectively. On the surface, it makes perfect sense that people would want to dive into this juicy dividend yield that has hovered in the double digits for most of the last 12 months. And let's be honest here, it's hard to say no to cash flow like that until we dive a little deeper into the analytics. In this video, I'm going to share why buying SCHD or VU is better for most investors, including all long-term investors. Now, JEPI does have a niche, but it's just extremely narrow. Let's look further into JEPI with the following 5 topics. What is JEPI? How is it managed? Who should buy it? What is the return history? And how does JEPI backtest versus VU and SCHD? If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy videos like this, please feel free to drop me a comment down below. Whether you agree or disagree with the material, let me know. I appreciate all feedback. Give that video a like, subscribe if you haven't already, and tell a friend about the channel. I really do appreciate you. You're helping get this stuff out there. What is JEPI? JEPI is the JP Morgan Premium Income ETF. Its managers buy companies from the S&P 500 that they deem to be value investments. They're looking for stocks with lower volatility relative to the index. It has about 140 holdings that are really well balanced by weighting and by sector. No individual holding exceeds 2% of the total weighting, and the top 10 holdings are a mere 15% of the entire ETF. The fund's advisor enters equity-linked notes, which are known as ELNs, to try to match the return of the S&P 500 with covered call options. The premium income produced by the covered calls will usually increase as the market volatility increases. In other words, the dividend payments are higher when the market has more volatility. It has an expense ratio of 0.35% or 35 basis points, which means that you pay $35 per year for every $10,000 that you have invested in JEPI. How is JEPI managed? JEPI is actively managed, and its 0.35% expense ratio is actually pretty darn reasonable compared to comparable funds. That said, 20 basis points is my absolute ceiling for long-term investments. I roll with passively managed funds that, by their nature, tend to have lower expense ratios, and they also tend to have a lot better performance over the long run. One of JEPI's primary objectives is to match the total return of the S&P 500. Now, the primary difference between JEPI and the S&P 500 is that the majority of the returns will come in the form of dividends from JEPI, which is another one of its goals, to provide high monthly income. Both of JEPI's managers have over 30 years of experience each, which is probably a good thing for a fund that lives and dies on call options. Who should buy JEPI? A quick note, this video is not financial advice. Please always do your own research before making an investment of any kind. I'll cut right to the chase on this one. You shouldn't buy JEPI for long-term investing. Money invested in JEPI for 10 or more years with dividend reinvestments turned on will very likely fall short of the total return of something like SCHD, definitely VU, and many other of the low-cost passively managed ETFs. VU, ticker symbol VOO, being the index of the S&P 500, the largest companies in the United States. This is often referred to as the market. And SCHD is a quality dividend ETF that consists of 100 companies, each of which has paid dividends for at least the last 10 years. And I feel like I need to add a little more context here, because you would look at the yield of JEPI sitting at 10% and the yield of SCHD sitting at 3.5%. And you think, why on earth would I go for SCHD for cash flow needs? And that is a very valid question. The answer is the dividend CAGR of SCHD, and that's the dividend compound annual growth rate. This particular metric does not have anything to do with the price appreciation, and it doesn't directly reflect the dividend yield. The dividend yield does matter, but what it is how much the dividend paid has grown over the last 5 years, if you're looking at the 5-year CAGR. So for example, right now SCHD sits at just under 14% on its 5-year dividend dividend CAGR. This means that if you own 100 shares of SCHD today, in about 5 years, whatever the dividend is paying you today without reinvesting it, no new money going in 5 years, it will be paying about double. So if you're making $100 of dividends, 5 years later, you'll be making about $200 of dividends. And now the 5-year CAGR is pretty high. So even, stretching that out, let's just assume every 6 years it doubles. It falls off a little bit. That still gives it a huge advantage over JEPI. So for a quick scenario using easy numbers, if we were to put $1,000 into JEPI right away this year, it would pay us $70 to $110 of dividends per year. Like if the yield is around 7%, which is around its 7-day yield, or 11% is what it historically was at. We'll just say $100. It pays us $100 a year. We'll use 10%. That won't grow. See, it's more like a high interest savings or a money market. The yield will go up and down depending on the volatility of the market, but you won't see a consistent growth over time. Now, if you put that same $1,000 into SCHD, you'd only get a measly $35 this year. So the person that's getting $100 would be laughing in your face, but 5 years later, those same shares would get you about $70. And 5 years after that, same shares, $140. 5 or 6 years after that, same shares, $280. I know the math doesn't seem realistic. It really does work like this. And that's why for a long-term investor, you very likely would want to go with SCHD or another quality dividend ETF to build your wealth. And as a quick side note, even though you get that measly $35 in our $1,000 scenario with SCHD, and you get that juicy $100 with JEPI, the total return over the last 3 years, which covers JEPI's whole history, has been higher with SCHD. So it takes time to ramp up those dividends like I was talking about. But if you zoom out and look at your total return, so basically you're adding in price appreciation as well, SCHD has outperformed JEPI. If you're retired and you're living off your dividends and you need more cash flow now, and I use need literally, then JEPI is a very solid option. It really is. It has an impressive, albeit short, return history. And in that scenario where you need cash now to survive in retirement, I think that JEPI will exceed the total returns and the cash flow of any money market or high yield savings account over the next 10 years. But the VIX, that volatility index I referred to earlier, has been relatively high over JEPI's lifespan so far compared to what it has been historically. So I do think that the juiciness of the call options will calm down a little bit, but you'll still be looking at anywhere from 6 to 8% yield, I would imagine. Another downside of JEPI is that the majority of its dividends paid will be taxed at your ordinary tax rate because they are not qualified dividends. SCHD and VU and other ETFs that hold US companies are usually taxed as qualified dividends, which will save you a lot of money regardless of what tax bracket that you're in. They're taxed more favorably. All right, let's dive into the return history. I've pulled up JEPI on Seeking Alpha, which is my favorite website for doing stock research. The 1-year price history is down 5% for JEPI. Let's jump over to the holdings tab. You can see the holdings breakdown is very diverse by sector. You're anywhere from 17 to 9% on technology, healthcare, industrials, consumer defensive, financials, and consumer cyclical. And then you have a little bit of communications, utility, basic material, real estate, and energy as well. The top 10 holdings of JEPI are recognizable companies: Amazon, Adobe, Microsoft, MasterCard, Comcast, AbbVie, and on down. And as you can see here, each company is a very small portion of JEPI. So as far as its core holdings, JEPI is not overly weighted in any sector or any individual company. Now we jump over to the dividends tab, and on the scorecard here, you can see that the current yield of JEPI is a juicy 10.2%. That's on the trailing 12 months, which pays you $5.57 for every 1 share you own, which costs about $54. Therefore, that's how you get the 10% yield, $5 for every $50 you spend. It doesn't have 5 years of history yet, so there's no growth rate information. But again, this is going to be up and down, and its dividend growth has grown for 2 years. So here's the last year of its dividend yield. And as you can see, it has 10 to 11%, touch 12 right there. So this thing has a powerfully high dividend yield. I will say it has been dropping as volatility in the market has decreased. And right now its current 7-day yield, so more real-time data, is between 7 and 8%. And on its charting here, you can see JEPI by its price, which doesn't make sense to assess JEPI by, is down 5%. Now, if we get a more fitting metric, and that is total return for JEPI to include those dividends, you're actually up 5%, hence that 10% yield. And if you look at JEPI year to date, you're up 5%. Let's add in our comps of VU and SCHD and see what we're looking at here. So year to date, JEPI's up 5%, VU is up 16%, and SCHD is down 1.5%. If you look at the 1 year, SCHD is flat, JEPI's up 5, and VU is up 8. And the last one we can do here with JEPI's short history is the 3-year history. So on the total returns, JEPI's at 33%, VU is at 34%, and that's the market, and SCHD is at 41%. Now, JEPI is looking solid here on a total return basis, and you never know, this could continue. I just believe the market volatility will revert back to its historical norms. You know, it'll be high sometimes, low sometimes, but all things considered, it's been quite the ride the last 3 years, which again helps JEPI. But I think when the market normalizes, we are going to see VU pull away, and very likely SCHD pull away. So I think this 3-year chart so far, JEPI's off to a great start, and it's still fallen short of VU and SCHD. I think that trend will continue in the future. Okay, let's jump right back over to my screen, and we're gonna check out a 3-year backtest of JEPI versus SCHD versus VU. I'm out on Portfolio Visualizer, which is one of my favorite websites to backtest portfolios against one another. And what we're going to do here is we're going to look at 2021 through 2023 with year-to-date included. Now, the reason I don't have 2020 in here is because that's when JEPI was formed mid-year. So that would give VU and SCHD a half a year head start, which wouldn't be fair. So we're going to have a clean start of 21 through 23, so 2.5 years. Now in this case, we're going to take $500,000. This is someone that was putting money in their 401k or their investment accounts. Instead of starting with a small amount here and putting in a monthly contribution like we normally do, we're going to reinvest the dividends, display the income, yes. And then here is JEPI, VU, and SCHD as the 3 portfolios. So when we hit analyze and we check out the results down here, with that initial $500,000 in 2.5 years, JEPI would be worth $629,000, VU is $636,000, and SCHD is $641,000. Now these numbers don't jump off the screen because again, we have a limited history of JEPI, but even with it blowing up and being on fire and having everyone dive in its short history, it's falling short of VU and SCHD. And I believe this gap will widen significantly in the coming years. Now, if we look at annual returns, in 21, it looks like SCHD and VU were the kings. However, in 2022, VU was way down, that's the market, and it looks like JEPI and SCHD were about even. So far in 2023, VU is up 21%, JEPI 7%, and SCHD only 2%. And the reason these are slightly different on the 2023 than Seeking Alpha is because Portfolio Visualizer only updates once a month, and August has been pretty brutal. So the Seeking Alpha ones that I showed were a little more up to date. And this annualized return information won't be too impactful yet because it's only 2.5 years in. JEPI was at 9.3%, VU is at about 9.8%, and SCHD was at about 10.1%. Now here is where JEPI shines. Here's our portfolio income, which in this scenario, it's all being reinvested. So the total returns are all things considered up above. But for the actual cash flow, this is where JEPI is looking real good. You'd be looking at $38,000 compared to $18,000 of SCHD. This is sort of like that example we had earlier. And then in 2022, $64,000 of JEPI and $21,000 of SCHD for cash flow. And so far in 2023, you're looking at $27,000 for JEPI and 10,500 for SCHD. SCHD hasn't yet had the chance to ramp up, as I was explaining before with that initial investment. I look forward to providing a 5 and 10-year scenario in the coming years to show how SCHD will chip away at JEPI because of its dividend growth. JEPI is a solid choice for a small subset of investors, but check out this video here if you want to see how SCHD can really boost your cash flow long term. Thanks for watching, and I'll see you in the next video. Peace.